All right, everyone. So I want to talk about something. One thing that every business needs to survive. Anybody know what that is? I can't hear you. We need what? Money, exactly, capital. But raising capital in 2025 takes way more than a shiny pitch deck. The game has changed, people. The competition is fierce, and investors are looking for signals that go way behind the slides. So in this session, we're unpacking what VCs are really looking for, the common pitfalls that trip founders up, and the strategies that actually get deals across the finish line. So if you're gearing up for your next raise, or you just want to know how the game is played, this is your chance to get insider insights that can turn funding into a true growth milestone. So joining me, I should actually say join me in welcoming to the stage Associate Partner at Antler, Shambhavi Mishra, Managing Partner at Panache Ventures, Prashant Matta, Principal at Inovia, Morisset, and Senior Associate at Staircase Ventures, Robbie Marks.
Great. This is the last panel of the day, and I promise it is going to be a very exciting one that you guys will be talking amongst yourself. My name is Shambhavi. I'm an associate partner with an early-stage fund called Antler. I'm based out of Toronto. We are in a very interesting time right now. If you look at the news, early this year, almost, there has been a decline in the venture capital dollars that have been deployed in early-stage funding. First half of 2025, $300 million deployed across 133 deals, which is probably less, 16% less in terms of deal value, 30% less in terms of deal count. And this has been the slowest year since 2020. So these guys will be held hostage today. But with a big underlying but, I do want to say that the pace at which companies are coming up in Canada, the pace at which AI innovation is happening, the pace at which companies are fundraising, creating new categories, has been an exceptional time. So how do we make sense of all of this? Welcome to the panel. We have three incredible leaders from the venture capital space here. We have Prashant, Managing Partner of Panache Ventures. We have Robbie, who's the investor at Staircase Ventures. And we have Mia from the growth team, who's a principal at Inovia Capital. So how do we make sense of all of this? Let's just make a pledge right now that tell us the facts. Like, if you have to summarize this fundraising drama that's happening in 2025 in one word, what would that be, Mia?
My word would be polarized. You discussed AI craziness, but you still have those stories that are not in that wave that is still difficult to raise, so polarized.
Polarized.
I would say underappreciated. I think we have the numbers on one side, but then you also look at that AI tech talent in Canada. We've got 3 of the top 10 markets, including Toronto, Waterloo, and Vancouver. You've got Toronto, the Waterloo region, ranking 20th in the World Ecosystem rankings. And we've got, on the ground, all of us are seeing incredible companies. And so you have numbers on one side, and then you have some context on the other. And so great companies are going to continue to raise great rounds and grow fast.
Prashant.
I'd say rebound. Obviously, when you look at the financing data, it looks concerning, but in my opinion, that's always lagging, right? These financings are reported or self-reported by venture funds. But what we look at is demand side, which is startup creation. And when we look at startup creation, it's been robust since 2023. And it's a matter of time when the capital catches up, right? So my view is we're bouncing back. It takes time. It's a cyclical industry. And we feel very optimistic. I think lots of disruption happening with AI, lots of opportunities in the market. And you know, we started the fund in 2018 with a Canada First thesis, and I'm really glad to see a lot more focus on the Canadian ecosystem.
Great. There is an interesting murmur I hear amongst the founders, which is why I want to address the elephant in the room. Raising from US VCs versus Canadian VCs. If we look at the data, as per the media, 80% of Canadian VC deals in Q1 2025 involved US VCs, often pushing way higher valuations than what Canadian VCs would give. I want to ask you, Prashant, you've seen the entire past few years, how should Canadian founders balance this allure of raising capital from US funds versus looking at options to nurture more local relationships with Canadian funds?
Well, that's a tough question, right? So, look, I have a simple philosophy, which is capital will find the best talent. I believe we have the best talent here. If Canadians are not going to fund our companies, somebody else will, right? And so I think in the end, the founders have to raise capital to achieve their visions and missions, right? And it's a great opportunity for the Canadian ecosystem to boost the funding levels in the country, everything from early stage to late stage, right?
Yeah.
And every time I'm in different circles, I hear a lot about, oh, Canada has a scale-up problem, which in many ways is true. But in my opinion, scale-up problem starts at the pre-seed stage, right? So when we look at the financing data you're talking about, 133 pre-seed financings in first half of this year. Now let's apply simple math to it. Let's say 10% of those companies graduate to Series A, B. What we're talking is less than 15 companies from that entire cohort having a shot at later stage down the road, right? And so I think there are lots of opportunities for the ecosystem to build across different stages, right? And if we don't fund the great talent in Canada, either the talent will leave or someone else will fund them.
Yeah. Which actually propels me to ask you, Mia and Robbie, as a Canadian fund, do you see yourself adapting in terms of speed of execution, transparency in valuation terms? Like, are you looking to raise the bar within the venture ecosystem as well?
I don't think Inovia has changed that much, but I would say that one thing that changed, and I think that goes to your point, like all the stats that you mentioned are actually like the 80% are coming outside of Canada. That's more on the later stage front. The stats are different on the earlier stage front, and that's because there's just less Canadian funds investing in Canada.
Yeah.
And we're starting to see that to change.
Yeah.
I think we've seen in the news, pension funds have at least mentioned an appetite to invest more in Canada. When Inovia Growth was launched 7 years ago, we were the only one growth fund. Like now there's not a lot, there's more growth funds. So I think like there's more Canadian funds investing in Canada, which is going to increase the pool. We're starting to see faster processes as well. Like this summer, there was this Canadian Series C, 10 term sheets in 2 weeks. This is something that we don't hear all the time in Canada, and actually the highest bidder, my highest suspicion, is that it is a Canadian fund. Like half of the term sheet were US, half Canadian, and so we are starting to see some speed, but I would say we're at the start.
Robbie, what do you have to say?
I mean, I think Canadian VCs sometimes, with our historical, more conservative approach, take too long to make investment decisions. And so one of the things we do at Staircase Ventures is we get back to founders in a matter of 24 or 48 hours if it's not a fit. And if we're writing a term sheet, we can get to that conviction in days instead of weeks or months. So at least at Staircase Ventures, we're trying to build that momentum and work with companies to get their deals done fast. And we want founders to get back to building. They shouldn't be spending 6+ months raising around.
Yeah. That drives me to the next question. I know a lot of founders in the room are thinking about fundraising, and it's important, especially Mia, when it comes to the process of fundraising, in our conversations, you've often, stressed that pre-nurturing phase is as important when you're actually out there to fundraise. But on the other hand, there are some investors who say that fundraising has to be a very tight process, tight timelines, like Robbie says, and then these founders come to us to ask which one is the true reality. What would you say to that?
So we're not able to take a decision in a matter of days if we've never heard about this company before. Like, this is why I think once we know the founder, we've built trust, and this is something that, hey, we can actually move fast. He's already met all the team. It's just, refreshing our thinking and making sure our investment makes sense, that we can be fast. We're in a business of relationships, so for us to issue a term sheet when we've never heard about the company is very challenging. So that's why what we recommend to our companies, actually, like, this is a 10-year relationship. Just using the highest term sheet in the process of 2 weeks, will you get the best partner for the next 10 years as you're building? That's something that we're trying to share with our companies. So we do recommend to them, like, if they know they need to fundraise, 6 to 12 months before, like, what are the top 5, is it 5, is it 10 investors that are actually true potential partners? Build that relationship. And I'm not saying doing quarterly, like weekly calls, but make sure you can build that relationship. Them. So this way, this is in our opinion, the best way you can get multi-term sheets in a short time of a process. So I do think there's this process that should be short, but the nurturing for us is key.
Yeah, and nurturing is very important. Like, even at Antler, there is a method to the madness. It's not that you just keep sending emails to investors, but it's also the subtle things, sending a monthly newsletter, keeping them up to date. That's from a growth perspective. Robbie, you've often stressed, like you've just mentioned, fundraising processes are taking anywhere from 3 months to 6 months, seed to Series A rounds. What does a disciplined fundraising process look like? Like, you being at Staircase, what are the kind of founders that you've appreciated who have run a good end-to-end fundraising process? And the second thing I also want to emphasize is, why is it so important for them to be talking about why them and why now?
Thanks, Shambhavi. So I agree with Mia that you can start building relationships, but building relationships is not your technical fundraising process. And so ultimately, I think founders need to communicate an inevitability and the sense of a with or without you energy. And so you want to show to investors that you have insane conviction in what you're building. It's going to happen whether or not that investor is going to invest in your company, and you're giving the investor the opportunity to come in and support and help you grow. And so with that in mind, you want to structure your fundraise in a process where you set up your first meetings with all of your potential investors in the same few-day window, line up your second meetings with those investors in the same few-day window, and in that way, you can speak to the investors you're talking to and say, we're already discussing this fundraise with several investors. We've got lots of second meetings lined up and investors looking in our data room. And so that builds that sort of inevitability, sense or with or without you. And you can actually say those things without lying, because investors will definitely not invest in you if you're lying. And if you're going one investor at a time over a 6-month process, you're never going to be able to create that structure to raise a successful round.
Great. So we've covered what is a disciplined fundraising process. I want to now talk about traction. Oftentimes when I have to say no to a founder, we have some templatized replies. VCs have templatized replies, but I want to unlock it. Mia, as being a growth investor, we constantly get compared to companies that are fundraising in Silicon Valley. Growth investors are expecting, in the age of AI, companies should go from 0 to 5 million ARR at the blink of an eye. This is not realistic. Like, this is not the pace at which foundational companies can keep up. As a growth investor, what do you think is a good enough traction? And then I'm going to ask the same question to Prashant. Mm-hmm. What is a good traction, keeping aside the outliers which we are seeing in the media these days?
Yes, because I would have said I wish I would have seen the 0 to 50 million ARR every week, but I don't. Those are still outlier story. I would say what's we probably have similar criteria than you guys on the earlier stage, like team, TAM, all these things. I think for us is you've reached a certain scale, probably a Series B, let's say, probably around the 10 million mark. Is that growth sustainable? Is that growth, is the technology scalable? So those are the typical questions. I would say what's changed at the Series B-ish over the past couple of years, with this new AI world, where do you fit? So that's something that we're going to focus on more now than ever. Efficiency, we expect companies to be built with a lot less resources. So all these focuses on, burn multiple, magic ratios, whatever is the right KPI, that's something really important for us. And I would say the third KPI that changed a bit is on retention. A lot of the emphasis was based on net dollar retention in the past, but when you really dig in, especially in the wave of AI, you realize there's a lot of like hyper growth happening, but then there's a lot of churn happening as well. So going a lot deeper on the growth retention profile of your customer base, especially in this PLG mode, those are also something that has changed a bit in the milestone that we're looking at the growth stage.
Has the Bessemer formula of double, double, triple, triple, are we coming up with new formulas now?
So I would say that formula was not true anymore for the past 2 years, but it's starting to be back. We're seeing a lot more faster Series B and C. I think in our growth fund, we haven't done any Series B in Canada for the past 2 years, and now we're seeing really interesting stuff happening in Canada. So I'm bullish.
And Prashant, from your perspective, like being one of the most active early stage investors, what does good traction mean for a pre-seed company and for a seed company?
So at the pre-seed stage, it's really about the team and thesis. And at seed stage, we expect the companies to have some level of traction, right? And the question about how companies in the Bay Area getting funded, I was just in the Bay Area last few days. This is what I learned. If you're app layer company in the AI stack, you're building app layer. If you're not going from 0 to 3 to 12 million in annual revenue, it's going to be hard, because that's where the market is today. Now, that may change, and it will change in my opinion, but that's the perception founders will have to fight if you're trying to raise capital there. The story is slightly different if you're investing or building in the infrastructure layer. You're not going to get a pass on technical defensibility because you're building infrastructure. You do need to show some level of traction, but the traction, more important than traction, is, are your economics compounding?
Yeah.
And can compound over time, right? So you might get a pass a little bit on your growth curve when it comes to infrastructure, but not at the app layer, right?
Yeah.
So when we're investing in pre-seed and seed stage, these factors do go into consideration, because we do want to understand if that business is fundable at the A round and beyond, right?
Yeah.
And so while 90% of the thesis at pre-seed is really about the founders and their ambition, their thesis, and depending upon what they're building, ideally for us, a technically defensible company, but we do want to understand where the market is. And today, that's where the market is.
How do you define defensibility? Sorry, this is a question outside of the script. In the AI age, everything is becoming, everybody can build everything.
Nothing defensible at the app layer in my experience. However, where we've seen success are with founders that are very vertically focused, right? They know the domains very well, and they know distribution very well.
Yeah.
Right? Because imagine this, right? You launch an agent company or some sort of a vertical AI company. There are probably many other competitors in that space. So we want to understand that you can distribute faster than most of your competitors in the market.
Yeah.
With the assumption that everybody's building on the same technology stack, right?
Yeah.
And so I think defensibility in the app layer is challenging unless you have some level of distribution and you can build your own data moats around that. We've been a lot more active in the infrastructure layer because we believe, our thesis overall in AI is that the stack is being built and evolved as we speak, right? And it will only get better. And so we're taking a lot more investments and bets in the middleware and the infrastructure layer because our view is it's really hard to pick at the app layer. And so we want to enable this ecosystem and grow with that ecosystem. And we find a lot more comfort investing in more technical, foundational infrastructure layers.
Great. I want to move to the next question, which is mostly on the AI bubble and the AI shadow, right? Since 2023, almost half of the VC dollars have gone to all AI companies, largely, and a lot of founders who are not building technically in core AI are suffering because of that. Mia, what would you advise such a founder who's not really a core AI founder? How do they manage this fundraising environment? Because VCs are flooded with companies with some form of AI, and a lot of these founders are actually, for them, fundraising is becoming way harder.
And that's actually a lot of our portfolio. Like the Series B, we're seeing a majority of AI first, but at the Series C and Plus, I would say it's still non-AI first companies, but like you need to have an AI story. It doesn't need to be AI first, but what's your defensibility in this new world? What are you doing on the customer-facing front? Like we need all our companies that were the typical, vertical SaaS application layer, system of records. If they don't have an AI strategy on the customer product roadmap front, or how they've been, just changing themselves on the internal processes, it's going to be difficult to raise.
And how about you, Robbie? How are you thinking about when you get companies at seed stage, which are not core AI?
Yeah, I agree with Mia in that there are lots of companies building that aren't necessarily native, like AI first, AI native, but you need to understand how AI is going to be impacting your business, and you also need to Prashant's point about infrastructure. But AI is the new infrastructure of technology right now, building on LLMs. Imagine trying to fund a company that wasn't using cloud when cloud came in, right?
Yeah.
It is the technology that companies are being built off of now, and so while you might not need to be doing something revolutionary as an AI first company, it needs to be part of what you're doing.
Yeah. In fact, there is a lot of wealth of information available, which as an early stage founder, even if you're building something which is non-AI, you can literally accelerate your revenue ops, GTM motion, using a bunch of AI tools. So that also goes a lot in when VCs do diligence, that how efficient in terms of capital usage can you be with the new age technologies that are available. Now, this is a time where we are going through an unprecedented pessimism, whether it comes to politics, the world, venture money, venture dollars. But we have to be optimists in this room. And I want to ask one eternal optimist in this room, who is Prashant. Tell us some story of a founder that you've recently worked with, or any of your portfolio, that truly stands out of how they got their fundraising done in the current environment.
By never giving up. Never giving up. There's one of my portfolio companies right now. They're closing a Series A round. And they had a couple false starts and a term sheet along the way, I should say multiple term sheets along the way that fell through, but they never gave up. And now they have a lot more attractive term sheet in the current environment. And so I think part of fundraising is kind of who you are as founders. It's the resiliency, right? Venture is a very cyclical asset class, and we have our ups and we have our downs, and it's mainly up and up, hopefully, from here. And so I think finding your own structure, your own process, how you sell not only your product, but how you're going to sell a piece of your company, which is fundraising, you got to find your own voice, and you got to find your own narrative, but never give up.
Never give up. That's great. That applies to each one of us in this room. Now, I want to have more of a closing question, and then I have a fun Q&A as well after this. Let's imagine Elevate 2026. What is the one piece of advice, genuinely that one piece of advice, that each one of you would like to give to a founder sitting in this room, sharing their data room with VCs, trying to fundraise, getting a bunch of no's? What should they hear from you?
In terms of, I like your hustleness that you mentioned, never give up. Like, we're looking for hustlers, that they're going to figure it out no matter what. So yeah, hustleness, agility.
Robbie?
I'll say you don't have to raise venture capital to be a successful entrepreneur. Understand what venture capital means and what it means for your business, if it is right for your business, and it's not right for every business. So I would say you can be wildly successful as an entrepreneur without raising venture capital.
100% agree. I think my comment around that is think global. Not Canada first, not America first, global. We're in a point in time in the current AI stack that you can build company anywhere in the world, frankly, and you can sell your product anywhere in the world, right? Depending upon what part of the layer or stack you're in. So I would love all of you to think bigger and think global as you go into 2026.
Yeah, and I would also like to add, understand your ICP, understand how VC maths, we were literally discussing this backstage, that understand how VC dollars operate. Then you will understand what is the incentives of these VCs who are trying to ask you all these sorts of questions. So understand your ICP well. Now, this is a lightning round. I'll go first with Prashant. If Canadian fundraising in 2025 was a Netflix show title, what would it be?
Netflix show title. I'll say Canada Rises.
Okay. Interesting, interesting. Robbie, if most fundraising processes that you have seen this year were a sport, which one would it be?
Oh, I gotta say a cricket match, because it
Cricket
never
match?
ends.
Have you played cricket?
Not properly, but
Okay, Prashant, we have to form a
Yeah,
Canadian
let's do
VC
it.
cricket team.
We should try backstage.
Great. And Mia, if you could ban one buzzword from every Canadian pitch deck, what would that word be?
Well, Prashant stole my line, but I was going to say Canada first. Think global is the right thing.
Great. Thank you so much, Prashant, Robbie, Mia, for being so honest and true in this panel. And thank you so much for everybody for listening in so patiently. To all the founders sitting here, don't give up. Like, chase these VCs down, but know your ICP. Thank you.
Thank you, everyone.